Good day, Gains Squad. You won't believe the secret moves being made in the shadows of the central banks this week. The world's biggest players are quietly shifting billions in bullion while we sleep in the land down under. Today we dive into Russia's massive sell-off and the Bank of France's sneaky relocation of their entire gold stash. We'll also break down the latest technical levels for gold as it nears psychological milestones on April 21st. Plus, a deep dive into the LBMA standards that keep the big banks honest in the London Vault game. Just a heads up, I'm not a financial advisor, so do your own research before placing any trades. So the big question is, are central banks losing faith in gold or just rebalancing for a massive move? Drop a comment below with your take, and don't forget to smash that like and subscribe button for the squad. Let's jump in and see where the charts are looking absolutely spicy this morning. Let's see where the smart money is flowing today, because things are moving faster than a kangaroo in a Tesla. We've seen some wild swings in the last 48 hours, and it's time to separate the signal from the noise. Gold is currently sitting at $4,823.66 per ounce. That's a steady climb from the weekend, but the market's having a bit of a wobbler with all this central bank news. Speaking of news, the Bank of France just dropped a massive update about their sovereign gold reserves this week. They've confirmed that every single ounce of French gold is now officially stored on French soil in Paris. To get there, they had to sell off 129 tons of non-standard legacy gold bars. These were the old school bars sitting in the New York Fed that didn't meet the modern LBMA standards. They swapped those out for shiny, compliant bullion on the European market to ensure everything is good delivery. This massive rebalancing act actually banked the French government a capital gain of 12.8 billion euros. It's a proper golden entry for their balance sheet, showing that even the big banks love a good profit take. Meanwhile, over in the East, Russia has been doing the exact opposite to keep their economy from going under. Reports coming in this week show the Central Bank of Russia has been liquidating reserves at a record pace. They've sold roughly 15 tons in the first part of 2026, the largest drawdown since 2002. It's a move to cover those wartime budget deficits, and it's putting some serious selling pressure on the metal. However, Russia has just announced a temporary pause on domestic gold sales from late March through to July. This creates a bit of a supply vacuum that might just push prices back toward the $5,000 mark. Now, smart money. You might be wondering how these massive institutions actually settle these 100-ton trades. They don't just use a credit card at the local mint. It's all about the London Bullion Market Association. The LBMA sets the good delivery standard, which is basically the gold standard of, well, gold. To be LBMA compliant, a bar must weigh between 350 and 430 ounces. It also needs a minimum purity of 995 parts per 1,000 fine gold. When France settles these trades, they use loco London settlement, meaning the gold stays in the vault. The ownership simply shifts from one ledger to another, without the bars ever leaving the high-security basement. But because France wanted their gold home, they had to physically transport tons of metal back to Paris. It's a logistical nightmare that involves armoured convoys and some of the highest insurance premiums on Earth. This move toward repatriation is a huge signal that countries want physical control over their assets again. It tells us that in 2026, trust in foreign vaults is at an all-time low for the big players. Now, let's look at the Aussie dollar cross, because our local currency is feeling the heat right now. Aussie dollar is trading at 0.7174, which is a bit of a struggle for the bulls. For us gold getters in Australia, that weak Aussie dollar makes buying gold even more expensive at home. If you're looking at gold, the price is hovering near record highs for local Aussie investors. It's a tough environment, but it creates some incredible opportunities for those watching the charts closely. Let's optimize this entry by looking at the technical indicators for today, April 21st. The Relative Strength Index, or RSI, is currently sitting at 65 on the daily chart. That's getting close to overbought territory, but there's still a bit of wiggle room for a rally. Our immediate resistance is sitting right at $4,880 per ounce. If we can break through that, the next stop is the psychological barrier of $5,000. On the downside, we've got solid support at $4,720 to catch a fall. Traders, keep an eye on the moving averages. The 50-day average is currently providing a nice floor. If we dip below 4,650, then the market might really start having a wobbler. But as of this morning, the trend remains our friend, and the bulls are still in the driver's seat. Check out the euro-dollar pair as well, which is sitting at 1.1782 today. The strength of the euro is helping the French central bank's buying power as they restock their vaults. It's a game of chess played with shiny yellow bars, and we're just trying to catch the crumbs. The US dollar index, or DXY, is at 98.09, which is showing some resilience. Usually, a stronger dollar means weaker gold, but the geopolitical tension is flipping the script this week. We're seeing gold and the dollar rise together, which is a classic sign of massive global uncertainty. When the smart money is scared, they run to the two oldest havens in the financial book. We also need to mention the oil situation, with Brent crude sitting at $94.79. High energy prices are inflationary, and gold is the ultimate hedge when life starts getting too pricey. For my Aussie gold getters, this means your cost of living is up, but your gold bag is looking healthy. It's all about balance in this portfolio, and making sure you're not caught out by a sudden shift. I've noticed a lot of paper gold selling recently, where people are dumping ETFs to buy physical bars. This is exactly what the Bank of France did, trading the digital or non-standard for the real deal. There's a lesson there for all of us. If you can't hold it, you might not truly own it in a crisis. The LBMA's new 2026 standards are also making it harder for dirty gold to enter the market. They've introduced a new responsible gold guidance that tracks every bar back to the specific mine. This is great for ethics, but it makes the supply of good delivery gold even tighter than before. When supply is tight and central banks are hoarding, there's only one way for the price to go long term. This is a proper golden entry for anyone who has been waiting for a pullback that never quite comes. Looking at the 4-hour chart, I'm seeing a classic bull flag forming over the last 24 hours. If we see a breakout above 4,850, it's going to be a hold on to your hats moment. I'm also watching the silver market, which is currently at $79.83. Silver is lagging gold a bit, but it often plays catch up with a vengeance when the metal market moves. Keep an eye on the gold to silver ratio. It's currently sitting at 60-1, which is historically interesting. Some of you traders are asking about the dollar yen, which is at 158.93. The yen is weak, which is making gold incredibly expensive for our friends over in Japan right now. It just goes to show that your perspective on gold depends entirely on what currency you're holding. Back home, the ASX 200 is down 0.56% today, hovering at 8,900. When the Aussie stock market struggles, local investors often pivot back into the safety of bullion. We're seeing a lot of volume coming out of Sydney and Melbourne trading desks this afternoon. The big institutions are hedging their bets against a potential slowdown in the local property market too. It's a wild time to be a trader, but that's why we love the Goldie Gains community, right? We stay ahead of the curve by watching the central banks instead of just following the hype on Twitter. Speaking of hype, don't listen to the bears who say gold is a pet rock that doesn't pay a dividend. When Russia is selling it to save their nation, you know it's the most important asset in the world. When France is flying it home in secret planes, you know it's more than just a shiny metal. It is the ultimate insurance policy for the global financial system when things get a bit wonky. Let's talk about the LBMA auction process for a second, as it happened just a few hours ago. The London Morning Fix came in strong, showing that institutional demand is still incredibly robust. They use an electronic platform now, but the principle is the same as it's been for centuries. It's the moment the world's biggest banks agree on a price to clear all their orders at once. This morning's fix provided the momentum we needed to stay above that 4,800 level. I'm seeing a golden cross forming on the hourly chart, the 50 period crossing above the 200. For the technical geeks in the squad, that's usually a very bullish signal for the next few days. But remember, the market's having a bit of a wobbler with the latest inflation data out of the States. US inflation is at 3.3%, which is higher than the Fed's target of 2%. This means interest rates might stay higher for longer, which usually puts a dampener on gold. However, the market seems to be ignoring the Fed and focusing on the central bank buying instead. It's a tug of war between high rates and geopolitical fear, and right now, fear is winning. As a 30-year-old in this market, I've never seen a decoupling like this in my entire career. Usually, the old rules apply, but in 2026, the rulebook has basically been tossed out. We have to be adaptive, stay grounded, and watch the actual flow of physical metal between countries. The Bank of France's move to exit New York is a massive piece of the puzzle we can't ignore. It suggests a fragmentation of the global financial system that will benefit gold for years to come. If you're holding physical, you're basically betting against the chaos, and that's a winning bet lately. Let's look at our trade plan for the rest of the week as we head toward the Friday close. I'm looking for a retest of the 4,780 level to add to my position. If we get a shallow pullback, that would be a proper golden entry for anyone who missed the last run. Don't chase the green candles, traders. Wait for the market to come to you and show its hand. Patience is the biggest edge you have in a market this volatile and fast-moving. Also, keep an eye on the news out of Turkey. Rumours say they might follow Russia's lead and sell. If Turkey dumps their reserves, we could see a temporary flash crash toward 4,500. That would be the ultimate buy-the-dip opportunity for the long-term gold getters in the room. To recap, France has finished moving all their gold home, bankrolling a huge profit in the process. Russia is selling to fund their budget, but has paused domestic sales to stabilise their own market. Gold is holding strong at $4,823, despite a firm US dollar. Technicals are looking bullish with a bull flag on the 4-hour and an RSI at 65. The LBMA standards are tightening supply, making compliant bullion more valuable than ever before. And the Aussie dollar at 0.717 means we're paying a premium here in Oz. It's a complex web, but the smart money is clearly leaning toward holding the shiny stuff. What do you think is the next move for the central banks? Is China going to start dumping next? Let me know in the comments below. I read every single one and love hearing your theories. Hit that like button if you found this helpful, and subscribe to stay tuned to Goldie Gains. Keep your positions tight and gains golden. I'll see you at the next close. Cheers!